I wanted to do this now because, we hear about it, but with all the proposed, legislation that's currently in front of Congress, a lot of which are spending packages, politics aside, right? Me being a business owner, I understand that if we're going to buy something, right, say in the form of benefits for me, if it's paper, if it's, a copier, if it's, some type of computer or a printer or something to that effect, that cost, right? I need to come up with the money to do so. Well, I don't know that the government quite understands that. And what they've done is that they've lulled us into this false sense of security that, hey, put your money into IRAs, 401ks, TSPs, 403bs, save it for retirement. When you get out, everything will be rosy. Well, there's a problem with that plan, and that's the taxation of that account. Now, for those of you, I'm not going to talk about it so much this week, but I did just finish writing a book talking about exactly these issues. And that will be available to everybody in the future. You can get it either in a hard copy or an e-version. So stay tuned. I'm getting that through compliance right now. And, we'll talk about a lot of these issues. But converting to a Roth, right? The rules are different. Contributions, right? So we have limits and income restrictions and the amounts that we can put into these accounts versus if we've already elected to put money into an IRA and we say, hey, I no longer want to be in this environment, the government allows you to take that money and start to convert it over into Roth. So what I call it is either tax now, tax later, or tax never. And that's what a Roth is a tax never type account, right? So as we look at this, Senator Roth created the Roth back in 1998 and then added the Roth provisions to 401ks in 2006. Now, what I've found is that, as I started to talk to people about conversions in 2007, 2008, 2009, people love the idea of converting to a Roth, but they just didn't have the money to pay for the tax. And one of the rules of thumb is you never want to use the money that's already in the account to pay the tax that is due. So we have to find that money and we have to be prudent with how much we convert. It's typically, if you had $1 million in your IRA, you don't want to turn around and convert it all in 1 year because the government will love you, because you're going to get hit at about a 50% tax rate, depending on the state that you're in, right? So the 401k is a provision that, as I started talking to people, very few plans had the Roth provision. But as lawsuits started coming down the pike, a lot of private companies were being sued by not offering that section of the tax code in the 401k. A lot of plans have now added to the 401k in the form of a Roth provision. That being said, if you're able to contribute, we strongly encourage, with some guidance of your advisor, that you start to think about doing the Roth aspect for as much as you're able to. So here's the question I always ask everybody. Do you think taxes in this country, income taxes, will be lower, the same, or higher? And I'll wait. You can go ahead and type in your answer. I don't want this to be just me speaking to you. People will watch this later. Let's see what some of you say in the chat. I got 1 or 2 participants, so let's see what you said. Higher, much higher, right? So if we believe that, right, in our core belief system, then, and I'll have you know, I believe that too. I've been yelling this from the rooftops since 2005 when I was doing New Jersey 101.5's Road to Financial Success. But think about it mathematically. If you put in $10,000 today into an account, we'll call it a 401k, not with the match, just your own contribution, and your effective tax bracket or marginal, it doesn't even matter, right, is 25%. Okay, 25% of $10,000 is $2,500 that you did not pay tax on. But now if that amount grows to 100 grand, over 20 years, whatever amount it is. And now you're taxed even at a 30% tax bracket. You would have made a small mathematical miscalculation because we're paying taxes at a higher tax rate in the future on a larger sum. So what I say is, would you rather pay tax on the seed or pay tax on the harvest? And the answer is you want to pay tax on the seed when it's small and tiny and we can figure it out. But in case you're not convinced that taxes will be higher in the future, I'd like to show this chart. And for those of you, this is pretty current, right? This is, you can go here, anybody, you can look this up at any time. It's called usdebtclock.org. There's a lot of numbers on here. I'm not going to go through them all. There's three numbers I'm going to point out to you. Right now, this is our current obligation as a country, and that's $28 trillion. When I first started showing this clock back in 2005, 2006, we were at 5 trillion. Our country has a spending problem. They keep kicking it down the road. And if we're not going to pay for it, our children and our grandchildren are going to be bankrupt. Now, this number here is our combined obligations as Americans, our total US debt, right? These are the promises the government has made to us, unfunded liabilities like Medicare, like Social Security. And then this number here is the amount of tax revenue we're bringing in. We're bringing in 4 trillion, spending 28 trillion. You don't need to be a math major to understand that we got a problem in this country. Okay. That's why I think my belief system, and that's why I create the growth of my accounts in tax-free environments. Now, this is an example. It's hypothetical, it's anonymous, but it was based on a prospect client that was presented to me, and I had some conversations. And what I want to point out to you is that they had some money in a traditional IRA. And then, we have that money. And then they also had this other money that they had rolled over an IRA. They had another inherited IRA. They did a rollover IRA, and now they were with the new company, do a 401k with no match, right? So they're still continuing to drink from the Kool-Aid and putting money into those kinds of environment. And they're over their lifetime, if they live to age 100, they were like 55 at the time, right? The tax obligation on those accounts, if taxes stayed the same, not even went up, would have been in excess of $5 million. See, as we start to kick this can down the road and we end up, the money that is in those accounts are not tax-free. There's liens on those accounts. So we have to take into consideration, what are we doing to start to distance ourselves and what I call tax risk? We have to start to plan accordingly, that the government is never going to change their thirst for spending. We just have to be in tax environments that we're as immune as possible. So we recognize this gentleman, arguably one of the smartest men that ever said, and he's quoted as saying that one of the hardest things to understand in the world is the U.S. income tax. So I try and simplify it. This is our 2021 tax rate. And I want you to think of this as graduated cylinders. The graduated cylinder on the left, and this is for a couple married filing jointly, right? This is what it was pre-TCJA, which was the Tax Cut and Jobs Act. And this is what it was, backed up. And then the right column is what it went into after the TCJA. But the arrow that I have pointed over there in the upper right-hand corner, 12/31/2025, is the last day of the column to the right, and then it reverts as it is law right now. Now they're talking about changing that even sooner, but as it stands right now, this is coming. So on 1/1/2026, taxes will revert back to the graduated cylinder back on the left-hand side. And part of what I try and explain to help you to simplify this, not every tax dollar is taxed at the same tax rate. So you'll see there, on the left-hand side, 10%, $18,650 is taxed at 10%. That means we owe $1,865. The next dollar that we earn over that is taxed at 15%. So that's why when we use the term effective tax rate, it's like the combined blended tax rate of our overall income. And we have calculators that help folks figure that out. But this calculator, this is a tool that I use to help folks figure out, what is your, Roth conversion opportunities, or how much do I owe in Medicare premiums for Part B if I take a conversion? Just some technical questions. But this just allows me to take a complicated subject that most people don't want to sit back and think about, because you leave it to your CPA, you leave it to your accountant or TurboTax. And the problem is that typically, accountants do a great job, but they're historians. They're looking in the rear view mirror. And we firmly believe you should be looking out the windshield, right? So this couple was earning roughly $259,000. And in 2020, they had a combined, right? We lost our personal exemptions, but we have our standard deduction, which went up, was 24.8. We subtract 24.8 from 259. And that means that we now owe tax on $234,000 of income. All right. So now that you understand that, what does that mean from a tax bracket management standpoint? How much room before the next dollar gets taxed at a higher rate? And in this example, this client could convert IRA money of about $92,000 and still pay the same exact tax that they would have been, and reduce that tax risk that I talked about if the government raises taxes in the future. And that's what we think is prudent. And that's the offer that I make to the folks that I work with. Let's just see, right, if this is an option for you, right? So with that, now I'm going to take this into example. So 1/1/2026, that's the date that it reverts back over to the left-hand side. So in my example, $234,200 would fall into that marginal tax bracket there on the right-hand side. So what happens on that date, just by overnight, that same income now puts them at a 33% tax bracket, marginal tax bracket. And that is tax risk. And then if you have a loss of a spouse, right? Well, now you're filing as a single filer. And if that happens, you can see quite easily, you can now be anything over 191,000. You're like, well, listen, we had all this income that came in. I had to take RMDs. It bumped you up. And that's if taxes stay the same, right? Under current tax law. But now, how likely is that? Well, for those of you that never heard of David Walker, I've been, sharing David Walker's message since I first heard it, like I said, back in 2005, 2006, at some of the events I used to do. He's been the head of the government accounting office. He's been on the board of Social Security. He's basically the country's #1 CPA, CPA Hall of Fame. And he's been the comptroller general on both sides of the aisle, right? Under 10 years under Bush and the Clinton administration. So political affiliations aside, this guy has been yelling fire from the rooftops. And he's quoted as saying, in his opinion, regardless of what politicians tell you, any additional accumulations of debt are, absent dramatic reductions in the size and role of government, basically deferred tax increases. Unless we begin to get our fiscal house in order, there's simply no way to handle our ever-mounting debt burdens without doubling taxes over time. Doubling. And I was at Rutgers doing a class, and one of the people in the back of the audience, I remember he said, impossible. There would be a revolt. But what people don't understand is our tax environment right now is actually some of the lowest that it's ever been. This is a history of our income tax history, this chart. So I use $1 million down at the bottom because that's what everybody sort of feels like, okay, if I get $1 million in my retirement account, I'll be good, right? And that green line in the middle is, if we look back at our income history, right, that's the average rate of our income taxes since inception. On the left side of the column is the year 1913. That was the date that the temporary income tax went into effect, and it was at 7%. You look all the way to the right to where we are now, 2020, 2021, and we're at 35%. And we've been, now it's proposed to go back to 37. So arguably, you could say we're on the lower side of that green line that splits the middle. But, things tend to gravitate towards their means. If David Walker is correct, so let's just apply that example that I gave you. $240,000 that this person would owe in a 24% tax bracket. That was the tax bracket that person in the hypothetical example I showed you. Of that $1 million, it's not all theirs. They owe the IRS 240, right? So that's if they, over time under the current tax environment, if they took it out and they didn't take it in one lump sum, they could pay 240. But then we said, hey, on 1/1 of 2026, it's going to go to 33%. Well, now overnight, that's tax risk. Just went from 240 to 330. The government says, I want more of your money. But if David Walker is right and it goes to 66%, Houston, we have a problem. Now we're above the green line. Now that $1 million, of which you can only spend 340, the rest of it you got to give to the government for their desire to help every idea that gets presented to them in an effort to secure votes, right? So Roth or Roth-like or IRA options. You have the Roth IRA, but that's subject to income limits. You have the Roth 401k. There's no income limits, but contributions are limited by the plan. You have a Roth 403b. That's typically for charitable organizations, nonprofits. They also have no income limits, but the contributions are limited by the plan. Roth conversions. You have to weigh the pros and cons. It's not for everybody. But, because the taxes are due now versus taxable later. And if you're under the belief system, once I retire, I'm going to be in a lower income tax bracket, then don't do a Roth conversion. I have a video that I've done on, it's called The Horse Race, which talks about tax now, tax later, or tax never, which one wins the race, the horse race. And we go over the math behind it. But right now, it depends. It depends on your circumstances. And this is why you can't listen to water cooler advice. This is why people that try and throw blanket statements on somebody's individual capacity to retire has no clue, right? When are you taking Social Security? How much money do you have in qualified plans? Are you getting a pension? Do you have a significant other, right? I mean, there are so many variables along the way. But the number one question, where does the money come from to pay the taxes? If you elect to do this and you say, hey, I want to distance myself from the federal government's thirst, right? Because they're going to come a knocking. Now, the Secure Act, they kicked the can down the road from 70 and a half to 72. So now you don't have to start taking RMDs out. But has anybody heard of a lobbyist group of RMD proponents? No, doesn't exist. So what starts to happen is all this money later on, right? That at some point in time, all they do is adjust it so you have to take it out quicker. They've already shorted. I showed you that one example where they had an inherited IRA. That's where they're going to get you. They're going to not necessarily get you while you're alive. It's when you name your children or non-spousal beneficiaries that have to spend this over a short time frame. They've already done away with the stretch IRA. They keep systematically taking things away that would have allowed us to keep more of our money in our family circle of wealth than to turn around and allow us to keep it. They will get paid, and quite possibly at higher tax rates. So, I'm a firm believer that we want to have an enjoyable retirement, use our money, be able to not have the risk or the worries of running out of money in retirement. We want to make sure that everything that you've worked hard, 30, 40 years, securing, being able to have those moments. And maybe you built quite a nest egg and you're saying, hey, things are good. But once you say, hey, I have clients now that say, I'm never going to spend this money. Those are good problems to have. The question is, who do you want to leave that money to? Do you want to leave it to your family? Do you want to leave it to significant others? Do you want to leave it to charity? All good options. Or do you want to leave it to the federal government? Because just stroke them a check. They will be happy to accept your funds. That's why planning is so important, right? But again, most accountants, you ask them, hey, I want to do a Roth conversion. What can I do? They're like, I don't know. How much did you earn last year? So if this is something that you'd like to at least see if it's an option, what do we need? We need at least last year's tax return, preferably 2 years, right? So this is our disclosure, just says, hey, listen, anything that you saw here, These are my opinions. Retirement Wealth Academies is my compliance department. My Brookstone manages my money. They're my police, for lack of a better term. I didn't make up all this stuff, basically, is what it's saying. And these are, people I'm affiliated with. I'm president of Professional Planning Services. I'm a partner in Eagle Team Financial Pros. I'm a partner in Producer Partners. We love helping and training the public to help make good decisions. If you have questions, you'd like to learn more, just send us an email, send me a phone call. Love to hear from you. I'm really glad you took time to get out on this call today. If we can help you, do so by the end of the year, because again, I don't know what the future holds, but let's see what your options are, and we'll go from there. Folks, have a great day. Thanks for taking the time, and see you next week. Bye-bye.